Hello, are you a property investor who's really worried about the rising interest rate and inflation? If you are not alone. There's so many property investors, landlords alike, that are really worried about the rising inflation, especially when they are in a fixed rate at the moment. They're worried by the time their fixed rate expires, interest rate has gone up significantly. So they're really worried. I'm not sure whether the rental income they're currently getting would be able to allow them to remortgage their property in the future. In this video, I'm going to share how should real estate property investors respond to rising interest rate, because it's really worrying. People are really worried about this. Some of them don't really know what to do, and they're really worried, especially the ones that do not have a good tenant in their properties and the tenants are not paying rent as they're supposed to, and it's been a really difficult situation. Before we get to that, if you like this video or any of my videos, hit the like button below, subscribe to my channel for more of these amazing tutorials. So, before we talk about interest rate, we need to understand what the causes of interest rate are and why government decide to increase and decrease interest rate. So basically, interest rate is the interest that the government, the Bank of England, charges for banks for lending money through the central government or through the central bank. So that then become a blueprint or a base that the other banks would use to charge you if they lend you their money or if they borrow you their money. So basically, that is the base interest rate. So how the government use it? The government uses interest rate to actually persuade you to spend or not to spend, so to speak. Say, for example, if interest rate is low, the government is doing that to actually encourage you to spend more money, because they know that keeping the money in the bank will not do you any good. So what you do, you either invest that money or spend that money. Okay? So in a situation where, as we are now, where demand has literally surpassed supply, and basically people are really struggling to actually meet. Suppliers are really struggling to actually hit demand, and things are going so expensive. What the central bank does basically is to increase interest rates. So when they increase the interest rate, they're hoping that you yourself, instead of spending the money or investing the money, you will put that money in the bank to get the interest you would have gained for saving that money as savings. So again, that way they will control your behavior. So, and again, if people are buying less, then supply will surpass demand, and then obviously then things becomes cheaper again. Okay, so that's how they've been able to actually reduce inflation, basically. So inflation increases like we are now, the government increase interest rate. When they increase interest rate, then inflation goes down, because that means less demand, and then obviously supply will then equilibrium to demand, and then that then allow you to be able to buy things cheaper again. Hence the reason why the government is attempting to increase the interest rate so far. So for the past 10 years, we've been on the lowest interest rate you could ever imagine. Since 2008, the government hasn't increased interest rate drastically, because 15, 20 years ago, maybe 30 years ago, interest rate were at 5%, 6%, 7%, and some instances it was 15% as well. So those are a long time ago. So now we're in about 0%, 0.1%. Again, you can see it's significantly lower compared to the way it was 15, 20 years ago. So again, these are the ways the government used to control it. So how does that impact you as an investor? Right? Very important, especially as a property investor. How does it impact you? Basically, what that means, if you are in a variable interest rate, if the Bank of England increase interest rate, your mortgage payment or your interest payment increases accordingly. Right? Because your variable interest is on a tracker. It's called tracker. Whatever the Bank of England does affects your interest. If they reduce interest rate, obviously your interest goes down. If they increase interest rate, your interest you pay on your mortgage goes up accordingly. Again, if you're in a variable interest rate, that will impact you drastically. And there are some landlords that are in that sort of product because they don't want to pay the fixed rate. They just want to be on a tracker, and they believe they can save a lot more money that way. So if we know interest rates are going to increase, because I think it's going to get increased, The reason is because the Bank of England may want to control the inflation that we are in right now. The only way, one of the ways they could do it is by obviously increasing in interest rate. They're the one who caused this, really, to be honest, because they printed so much money during COVID. People got lots of money buying so many stuff, and now there are not lots of stuff out there to buy because obviously there are more people wanting than we can produce. So again, in this situation now, as a property investor, before the interest rate get hiked up, is the best time to review your portfolio. Right? Review your portfolio. If you've got 3 or 4, maybe 10, 15 properties, it's about time for you to sit down and see which properties you could remortgage, right? If the mortgage has already expired, or if you are on a variable interest rate, right? If you're in a variable interest rate or your mortgage is about to expire, now is about the time to literally go and remortgage the property. The good thing about remortgaging the property right now, one, property prices are significantly high right now. They're here basically, right? So if you had a property that you bought 3 or 4 years for £100,000, that property may worth about 120 to about £150,000. So now is the time to remortgage and then get yourself on a fixed rate, right? If you're able to get yourself on a 3 or 5 years fixed rate, you are in a better position, okay? Get yourself locked in. So whether interest rate increased in the future or decreased in the future, you are locked in. You're locked in for that 3 to 5 years. So again, that protects your investment. The reason why it protects your investment is because you now know what your interest rate is, right? You know if your interest on your mortgage is £300, you know for the next 5 years is £300. It's not going to change. That gives you the security to ensure no matter what happens with interest rate, obviously you are protected, okay? And that interest rate will not increase regardless what the situation is. And again, if you're a landlord or an property investor who wants to know their future is secured, that could be a better way to do it. Okay, and again, I'm not a mortgage advisor, by the way. I'm just advising you based on my own experience, so you can replicate that if that makes sense to you as well, right? So what that does basically, if you've got a couple of properties, suppose you have maybe, let's say you had about 4 properties, okay? You bought them on £100,000 about few years ago, and now you went and remortgaged those property at a higher rate. Okay, suppose those property came back at £150,000. So each property you would have generated an equity of £50,000. Property 150, property 250, property 350, and property 450. That is £200,000 on equity alone. So what you would do basically, you would remortgage that property and have that £200,000 equity. Right? Things to note here, if you remortgage the property at £150,000, your interest payment would increase accordingly because you are coming from £100,000 with 75% on it to 150 on a 75% on it. Obviously, your rent would have gone up as well, just to adjust to that increase. So if you haven't increased your rent, maybe it's about time to increase the rent before you even start to do your remortgage. So you need to make sure your rent is high enough to be able to remortgage at £150,000. So what you then do, once you've got that equity, and again, that £200,000 you would have made from your 4 properties is purely equity money. And you're not going to pay tax on that money. That's the good news, okay? The good news is you're not going to pay tax on that money because it's purely equity. You haven't bought and sold anything to make that money. So what you could then do now, because you know inflation, interest rate is going to increase, what you could do, you can go and buy yourself maybe 3 more properties, right? Buy yourself 3 more properties, and again, get those properties in a fixed rate and then rent those properties out. Right? Suppose you had 4 properties, you went and buy 3 more properties, right? And now you've got 7 properties, right? You've got 7 properties. Imagine each of those properties generating maybe about £500. You've got 5, 10, 15, 20, 25, 30, 35. You've got £3,500 rental income, gross rental, net profit in your properties. Okay? So again, that is a nice cushion to be in. Right? Again, if you haven't increased your rent, increase your rent to make sure that you are protected when interest rate goes up. And again, before you do any of the remortgages that you're intending to do with your 4 properties, basically ensure all the repairs and maintenance are done in your properties. If you have any issues with the properties, make sure it's done, right? Make sure the repairs is done nicely. What do I mean by that? If you have a fallen door, locks, the garden is not been done nicely, the front garden is in a mess, make sure it's in an immaculate condition for the valuation. Right? It's not just good for the valuation, it's also good for your tenant. Because if the property is well looked after, the tenant will be happy to pay you your rent. Right? But if you're not looking after the property, the tenant will not be motivated to even pay you your rent. So again, that is the benefit you get from doing the repairs, not just from getting that mortgage value of the property increase, you'll also get the tenant to also be able to look after your property nicely. And the thing to do to prepare yourself nicely against rising interest rate would be consider renting or using some of your properties as holiday let or service accommodation, right? So if you don't know what holiday let is, it's basically having a property that being rented in a weekly basis for families who are going on holiday. Suppose you live in London, you want to go on a week holiday in say Cardiff, right? And if there's a property that is there, you can rent a property with your whole family to stay in instead of renting a hotel, because hotel will be expensive for a family of 3 or 4. So getting a house, a whole house, would be a bit cheaper. And again, you make a lot more money that way. In average, holiday let property would generate you anywhere from 20 to about 40 or 50,000 pounds a year. And again, that's a massive return on your investment. And again, if you don't want to do holiday let, you could do service accommodation. Service accommodation is when guests book your properties for a night, couple of nights, or maybe 3 days, because they are in that area either holidaying or they're there for events. So again, that sort of strategy would make you anywhere from 15 to about, again, 40,000 pounds. And again, these are the strategies you can do to actually protect your investment from rising interest rates. And again, don't forget to remortgage now. If your mortgage expired, remortgage now. If you only got a couple of months or so, speak to your lender, see if there's a way you could come to some sort of agreement to pay that off without having penalties. Okay, remortgage, get yourself fixed in those rates, and then obviously pull that money out and then go and reinvest. Okay, and again, I really hope this video has been helpful. If this video has been helpful, hit the like button below, subscribe to my YouTube channel for more of these amazing tutorials. I look forward to sharing the next video. Thank you so much for listening.